following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, and I hope all of our listeners out there are faring well in this volatile environment that we find ourselves in again. My name is Mark Longo from the OptionsInsider.com, as well as many of the programs here on the Options Insider Radio Network, and I am joined once again by the yin to my yang, the anchor, indeed the rock of the show, good old Don Schlesinger from the Volatility Exchange. Don, welcome back. We missed you on the program last week, even though Bob did an admirable job filling in for you.
Well, thank you. Yes, always in capable hands when Bob steps in. So happy to be back and listen to the show with Bob. It was very interesting and glad he had a good time.
Yes, he did. I think he would be happy to dive in even more. We had quite a few topics. We only got to hit on a few there. He's got quite a few. I think he's been making notes on all of our various shows, and he wants to chime in and have some of the fun as well. He thinks we're hogging all of the fun for ourselves here.
Yeah, he's got an ambitious shopping list there.
He does. He does. We could do about 5 shows just on that list of his he has of topics to revisit.
He sent me the list when he knew he was coming on, and he said, here's what I'd like to talk about. And I just kind of chuckled as I read it. I said, well, you might get to 1 or 2 of those. And he said, oh, well, no, let's see how it goes. And when it was over, I said, well, how'd you do? He said, gosh, the time went by so fast. I really only talked about 1 or 2 things. I said, well, that's the nature of the show, so you'll be back.
That's a sign that we're doing our jobs well when the time just flies by and you can only get to a couple of things on your enormous lists. But now that the regular team is back together, we're going to dive right into our volatility review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is, of course, the portion of the show where we review the action that we've seen in volatility over the past week. And it has been an active week. In fact, as we record this today, it is a little after noon Central Time here in Chicago, and we're seeing the market sell off quite handily in the wake of an European Central Bank resignation. The S&P's down about 25 handles right now to 1161. The Dow's down nearly 270 to 1133, and the good old NASDAQ down 45 to 2483. And of course, commensurately, the VIX cash is off to the races, up about 12% or 4 handles to 38.39. So a very volatile day. It has been a volatile week. And maybe not as volatile as what we've seen in the past, but still definitely an active week. And we'll kick things off, as we always do, by tossing it to our volatility pit reporter, good old Mark Sebastian, a.k.a. the Seabass from OptionPit.com. And Mark, what have you been watching in terms of volatility for the past week?
Well, it's funny how, remember I told Bob, I think you want to treat, the Euro FX vol contract getting back to about mean, that mean level as kind of a buy signal for right now, and that would have worked out beautifully for you over the last few days, I think. The FX is certainly the euro is not having a fun couple of days, is it?
No, not exactly boom times for the euro.
No, and hey Don, where's the vol contract trading right now?
I'm trying to get it up on the screen, and the best that I can see in the suite from the CME group was 11:30 at 12:10, but I don't see a trade there, and I don't know that that could be a possible level because the settlement.
That's too low. No, we're way up above there. But
We're
yeah,
talking
no, I
about-
mean, so that vol contract was when it gets down to those means right now, that is your chance to swoop in because this sucker is moving around right now. There is a little rumor about Greece leaving the Eurozone. There's people quitting. There's all sorts of things. It's been what I would say a week of nothing. But volatility's, or VIX, excuse me,
VIX
is a little higher.
I think, right now.
Yeah, VIX is a little higher than we began middle of the week, and so is the market, I believe. Or it's right where we no, it's a touch lower, but it's interesting. We've literally, for all this quote-unquote realized volatility, we're 4 points away from where we closed last Friday.
Yeah, that's the kind of thing that you don't hear the commentators on, let's say, a certain news channel, financial news channel, mentioning on a regular basis that, we're pretty much back where we were.
I know. Well, I've been telling my option traders, believe it or not, the Condor has kind of been, and, I'm not Captain Condor trader, but, a protected short premium trade with some wide legs with the vol this high, as long as you keep some of those unit puts, that's been working out pretty well for you.
Maybe not
This was
Captain.
always-
Oh, good.
I'm sorry, Mark. This one's always kind of interesting. We talk about the premium sellers and buyers, and I explain to people that two people can establish at the same time, in fact, be on opposite sides of the trade, a short straddle or a long straddle, and trade that position for, a week or two, and both of them make money.
Win.
And people
Yeah, absolutely.
say, how is that possible? I said, well, you get all of this movement. The ones who are long keep doing all the follow-up trades and lock in the profits and keep on trading volatility. And the premium sellers sit there and say, I'm not going to let any of this bother me, and sit there and twiddle their thumbs, or they have these protective wings outside on the Condor. So you don't have to worry. And a week later, you're back where you started from, and you say, if I did nothing at all, that worked out pretty well also.
Yeah. This is options are not a zero-sum game in combination with different things. Well, then you'll get the guy being like, well, the guy that traded all those futures against you, you can get to the zero-sum game if you put enough players in. It ends with mom and pop losing the farm. That's not true, but no, I mean you can get to there's 1,000 ways to skin the option cat. The fact of the matter is yeah, they're not a zero-sum game, and vol is high and not high at the same time. It's really weird. We've got a really high intraday volatility, but we don't have a high range volatility, if that makes sense, Don. So it's a really weird place that we're in. My thoughts right here is, from the equity side, I would be selling time spreads left and right. I think that's the best play right now. And that has been the best play for the last.
So yeah, that's worked out fairly well for the past month or so.
Yeah, and the fact of the matter is that anytime we've got stuff like this, people are always afraid to own premium. You can own premium. You just you want to own gamma, and you don't want to own a bunch of Vega. And yeah, I would just be selling. I think selling the time spread is the play. So.
Yeah, you want a little bit of that gamma. I know this might be heresy to you, Don, but a little bit of that gamma in markets like this, especially if you have the longer-term short vol position to make money on the downside when this VIX does taper off, or when the volatility does taper off, as inevitably will be the case. Then you're all set.
That's actually one of the interesting things about time spreads or calendar spreads. We mentioned it quite some time ago when we talked about a few option strategies. That was one of them, and the ratio spreads, that they're tricky to manage because I was usually the buyer of the time spreads because that risk reward looks a little bit more like a short straddle. But the problem is that what happens is that your Vega is not related in the same manner that it is with a short straddle. And so with a time spread, when implieds come in and you're long the calendar spread, long the out month, it actually is detrimental to you. So you're kind of ambivalent because you're trying to keep it within some sort of trading range, but you'd also like implied volatility to go higher, and that doesn't happen all that often. So
I know.
Mark's talking about exactly the reverse of that in a situation where it might actually be the case where we are getting gamma, we're getting a lot of movement, especially in the near term, but where in a macro, environment, the FAR month implieds may actually be coming in. So that's kind of the ideal scenario for selling the spread rather than buying it.
That's exactly what I'm thinking, Don. You and I are like kindred spirits. I'm going to turn you into a primo hog yet.
Well, I'm not sure if we're going to go that
They're going to
far.
call you Don.
I'm willing to see the other point.
They're going to call you Don Byam Schlesinger.
What have things come to?
That'll be the day. Of course, we do cover the broad spectrum of volatility products here on this program, including Eurovol and the Eurovol contracts that are lighting up the tape over at the CME these days. And listeners may recall that a couple of weeks ago, Don and I discussed a ratio quasi-arbitrage spread that we could put on between the 1 vol, which was the 1-month vol contract, and then also the remainder of the 3 vol, which is the 3-month Euro vol contract, because they were trading at the same time period that they were showing a market discrepancy in the realized vol of the two contracts. And it seemed to be a good opportunity to do some arbitrage or almost arbitrage. And so we worked out a nice ratio spread that we put on, and Bob gave us an update on it last week. That spread has now closed out. So Don, why don't you give us the final numbers on how much money we put away? Do we have enough for indeed that private island in the Bahamas that we were talking about off the show?
Well, here's what was really interesting. We mentioned the fact that the stub, or the part that remained after the actual realized volatility or partial volatility, was logged by each contract. And of course, that can be different for 1 month and for 3 months. But then when the contracts were trading side by side, the price that they were trading at implied, or you could infer from that price, that traders were expecting a certain volatility in the remaining days of those two contracts. But the point was that the remaining days were identical. 3-month September would expire today, and the 1-month September would expire today. So we were covering the same, sometimes people call it the stub, the part that remains to the contract. And on our website, we kind of work this all out for everybody, where when you go to the data section and you look at vol series, you can see the contract prices, the partial volatility, the inferred volatility, even the predicted expiration settlement price from Robert Engel at the Volatility Institute. And it just caught my eye that these inferred volatilities were kind of out of whack. So we suggested that trade, and although last week Bob mentioned as he worked out the prices that it looked like there was about 50 cents or so in it, what was interesting was that before last week's show, and only 2 or 3 days after our show of 2 weeks ago, this thing kind of snapped right back into line, and there was $1.02 in the trade. Now, of course, if you're a nimble trader and you put something on because you perceive that prices are out of line, it goes without saying that you have to monitor such a thing. And if the reason for doing it no longer exists, and you therefore have made the profit that you had hoped to, you really should take the trade off at that point, because there's really no more justification for staying with it. So I might have argued that, well, I could have gotten out at $1.02, but let's just say we stayed in it right till the end. And that's instructive also, because basically, if we saw this discrepancy, we were predicting that the stubs would once again line up. So it's kind of instructive just from a mathematical point of view to see what this closing, value was. And I don't have the expiration today yet, but I had last night's settlement prices, and the 1 month was 10.80, and the 3-month was 11.68. Well, the recommendation was to buy one month at 9.55. So to 10.80, you made $1.25. And the recommendation was to sell 2.5 of the 3-month at 11.58, and it went to 11.68, so you lost a dime 2.5 times, or 25 cents. So we're right back to that dollar again. You made $1.25 on the long. You lost 2.5 times a dime, or 25 cents on the short. So you netted $1. And that was for the pure 1/2.5 ratio without any type of multiple. So if you had done this, perhaps say 2/5, you'd have made $2,000. 10/25, you'd have made $10,000. With, of course, the caveat that I mentioned going in, that these were prices on a screen, no guarantee that you could have executed at those prices or that you could have gotten any substantial volume there. But if nothing else, an interesting mathematical exercise to see the interrelationship between these two contracts.
$1 is nothing to sneeze at, sir. I'll take that any day of the week. That's
No, that was pretty good. And I guess the final observation to make as these two contracts go out today, and we anticipate the new October 1 vol and December 3 vol that will begin trading on Monday, is that once again, for yet another time in the consecutive series of all of the 1-month products that we have, I think this is now the 7th one, that basically we see considerable movement and trading opportunity. So the September 1 vol had a high print of 14.24 and then dipped to a low of 8.93, and that represented a 37.3% move during the life of the contract. And even the September 3 vol, normally the 3 vol products don't exhibit quite as great volatility or range as the 1 vol, went from a high of 15.22 to 9.38. That was an even greater move of 38.4%. So yet again, like a broken record, we point out that these contracts certainly do give you, in every one that's been out there so far, some very decent trading opportunities and surely some significant movement, almost always during the life of the contracts, in excess of 25, even 30%.
Yeah, it does sound like a broken record, but every month, every new contract we've listed, we've seen the same thing. These things are just true roller coasters in every sense of the word. If you want, I mean, given these days with so many liquidity providers and professional traders and even high-end retail really scouring the map looking for products that can offer them volatility and continued volatility, continued movement, I definitely would think the vol contract would be catching a lot of people's eyes these days. And speaking of which, I know we discussed this ratio spread on the show a couple weeks ago and again last week. I know it's hard to parse the numbers, but I'm curious, have you seen any signs that anyone has perhaps followed suit in the actual product and put on any sort of spread between the two contracts or anything along the lines of similar to what we discussed on the show?
No, I wasn't able to determine that, unless you have access to actually seeing the orders go in as spread orders. You can probably scour the tape, or I could have asked the market makers to see if there was anything that was offered or actually entered as an order for a spread as opposed to simply trading in the individual contract. So I wasn't able to determine that. But going forward, this is simply something that I would recommend to anyone who plans to trade vol contracts, be they the euro or hopefully on equity indices that we will have coming down the pike, hopefully not too long from now. Because of this relationship that I discussed, it's something that you really ought to keep your eye on, and it's something that doesn't always present itself in other products. So this is an interesting opportunity, and we also discuss it on our website in the area where we describe vol contracts, and we wrote a little piece on trading opportunities, the different kinds of trades that you might consider with individual vol contracts or playing one off against the other in spreads or quasi arbitrage. So just something to add to your arsenal when you do decide to take a look at these products.
It might be interesting then as well, as you're talking about what you've added to the website, to maybe put together some tool for other scenarios like this down the road when the two contracts overlap, the 1 vol and the 3 vol, and they have a little bit of a time left on each of them, maybe a ratio calculator to help foster this type of arbitrage opportunity. People can come in and look at that, and they can plug the contracts into the ratio calculator and see exactly what ratio of the 3 vol versus the 1 vol they need to do to put on the spread like we did last week or 2 weeks ago.
Yeah, that's a very good idea because the numbers are kind of there, but if you're just looking at prices, it's not immediately apparent that there might be this opportunity. So that's a good idea and perhaps something that we could implement and just provide a little bit more information for our listeners and for ultimate traders.
Yes, I mean, obviously the math is relatively simple. People can do it on their own, but the more hurdles you remove from their path to the contract, the more idea generation you can provide for them, the more paper you can drive in those products.
I think that's absolutely
all right,
true.
Don, that is going to do it for the volatility review segment, and now we're going to dive into, I suppose you can call it a hybrid volatility viewpoint / listener feedback segment.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and welcome to the Volatility Viewpoint. And this week, we're actually going to give Don a chance at rebuttal for some of the things that we discussed last week with Bob. And actually, we have a question to this effect as well, so we won't save it for the mailbag segment. We'll just read this first question now. And it comes from our forum on the optionsinsider.com, and it was posted by a user who goes by the strange handle of Thomas. Usually people don't use their actual names. People use some sort of crazy fake pseudonym. So
might not be his name. His name
that's
might
true.
be George.
That's his idea of a crazy handle, is picking Thomas. And Thomas writes, I enjoyed the conversation last week between Mark and Bob about the volatility feedback effect. They mentioned that Don is not a fan of this theory and that Bob and Don have had many fights on the subject. I'm curious what Don's issues are with this concept and what he feels is the truth on the matter. And of course, Bob and I discussed this concept last week on the program. I thought it was interesting that Bob thought he came to the concept all on his own when I've read some literature to this effect in the past. And it's interesting, like I said, I've read literature on it and I've read discussions of it. I've never actually met a proponent of the volatility feedback theory before until Bob came on the show. And it is an interesting theory. Just to recap for our listeners who might have missed the show last week, we all know, obviously, we've discussed many times on this show in the past that when you trend down in the market, when you travel down that skew curve, the corresponding movement in volatility is to the upside. And the volatility feedback effect posits, well, does it actually work the other way around? If you raise volatility, does that send the market spiraling downward? It's an interesting theory. It's not one I particularly subscribe to myself, but I think it's an interesting one to mull. And I know Bob has put a lot of effort and a lot of time into mulling it himself. And I hear a little birdie told me that you and Bob have had some pretty heated, let's say, discussions on this topic. So
He likes to call them knockdown, drag-out fights. I like to be a little more gentlemanly and say we have some discussions and differences of opinion.
Well, Don, since you did miss the show last week, I will now offer you your opportunity to dive in and weigh in on this weighty subject of the volatility feedback effect. I'm guessing from your tone that you kind of fall into the same camp that I do, that you're not exactly a huge proponent of this concept.
And I'll try to, justify my point of view. I always respect others' points of view, especially Bob's, who's very knowledgeable in the area. But to me, it's just, you observe the markets, you see what's going on, and I want to believe my eyes and ears as to what I see all the time. So first, let's start with the concept that what we're really talking about here is relationship between volatility and equity price movement. And what isn't up for debate is that with equity and with volatility, there is a negative, very strong negative correlation, about 80%, which means that the great majority of the time, and we've mentioned it over and over again, when equity prices drop, volatility increases, and I'm purposely not saying implied or realized, but I'll get to that in a minute. And when equity prices rise, volatility decreases. That's simply an observable phenomenon that all of our listeners are familiar with. So that's not really up for discussion. What the discussion centers around is what is the cause and what is the effect. So chicken and egg, which comes first, if there is a first? Does the market drop and then perception of volatility rise? Does the market rise and then perception of volatility drop? Or somehow could it be the other way around, which is Bob's thesis? So let's start by saying that for the purpose of what I've just mentioned, the only volatility for the moment that we can really talk about, if there were to be a chicken and egg and which comes first, is perception, is implied volatility. Because it goes without saying that realized volatility is always the product, the after effect of market movement. It can't be any other way. Realized volatility is calculated by a formula whose input is the data points of the log returns of how the market moves. So we can't be discussing realized volatility at this particular moment. I'll bring it back a little later on. But at this moment, if we're going to talk about cause and effect, well, of course, market movement always causes realized volatility. So that's not on the table for discussion either. So now we're left with implied volatility. And implied volatility as expressed how? Well, through options prices. And if we're talking equity, well, then the S&P 500 and the implied volatility of options, which in turn creates the VIX index and is our sentiment indicator of perception of risk. And so now the question comes, what comes first? Does VIX kind of spontaneously rise or fall all on its own just because options traders have some sort of wave that comes over them and says, let's raise our implied volatilities or drop them? And then the market dutifully follows and does the opposite from what happened to implied volatility? Or is it the other way around? And so the first thing that I would point out is that it isn't possible to trade options in a void. Options are derivatives. They derive their values from some underlying that exists. And everybody knows that if the underlying is not trading, or on a stock, if they shut the stock down, or, whatever the reason may be, then the options shut down along with it. So you can't trade options on an underlying when the underlying itself is not trading. But the reverse is not true. And so every single day we trade in the aftermarket, and before options open, we trade futures. We trade the S&P futures. You can look at midnight, what's happening on Globex, and take a look at where the market's probably going to open the next morning. So we often see the market up or down as expressed by futures activity, whether it's Dow futures, S&P futures, NASDAQ futures, and the options aren't even trading. So we turn on the TV and we find out ECB, there's a resignation, or something's happened with the European banks. There's a piece of news that's come out. The futures react badly to that. The market drops, and the options have no opinion. Why? Because they're not even open yet. Now the options start trading, and we look up at the top of the screen on CNBC, and they put up VIX, and whoa, what a surprise. VIX is up 3 handles, 4 handles, 5 handles, whatever the case may be. So to me, if I've got a pair of eyes and I've got a pair of ears, I have to believe what I see. What I see is first the market dropped, and then when they got around to it, the options opened and implied volatility rose. the inverse correlation that we all suspect. Now, to say that it could happen the other way around, you'd have to kind of say that, first of all, both markets are open because the options are never open alone or before the actual equity markets. And second of all, you'd have to sort of imply that here we are on some sleepy day in the middle of the afternoon. There's not much going on. Markets open. The options markets are open. And all of a sudden, all of the options traders blow a whistle and they say, hey, guys, let's ramp up our implied volatilities 5 points. We think we perceive greater risk. Everybody up. And then after they do that, the stock market takes a look at that and says, oh my God, implied volatilities went up 5 handles. We better go down. The day that you see that, Mark, you let me know, okay? Because I've never seen such a phenomenon. I've never seen, options traders act in that manner.
Yeah, it's one of those weird phenomenons where we've seen numerous examples of what you just discussed, which is the market dropping and the implied vol increasing, but it's pretty much impossible to really test the other scenario. There are no scenarios I can think of where implied volatility or volatility on its own just moves with everything else being static, and then we could see what happens afterwards once that volatility shifts. It's just it's one of those nice theoretical questions, but I'm not sure you could really test that hypothesis in the real world.
And at some point, Bob said, and I'll certainly grant him this, that, well, maybe it's really not cause and effect because, these things really kind of tend to happen simultaneously. And of course, most of the time, that's true. We've got market participants in every conceivable area, futures, options, cash, whatever the case may be. Piece of news comes in. It's not a contest. It's not a race to see who reacts first. I assume that options traders have the same pairs of eyes and ears that stock traders do. So if some piece of news comes in that's going to send the market in one direction or another, that's going to be reflected more or less simultaneously in the options markets, in the futures markets, in the cash markets, in everything that's open and trading. So I certainly don't debate that particular point, but to say that there's some sort of cause and effect where the perception of risk comes somehow first and then the market prices follow, that's just something that I can't wrap my head around and that doesn't seem terribly logical to me. Now, I will say that there is a time, and you and I have discussed it more than once, there is a time when options implied volatility just kind of spontaneously moves in one direction or another, and very often higher, and that is in anticipation of some known event that is coming down the pike, like earnings for a stock or an important number coming out like unemployment or in front of the president's speech or what have you, where the perception is that something is about to happen that could cause volatility, could cause large price movement, but there it's in either direction. So this is a different kind of relationship and not the one that Bob was discussing. It's not volatility feedback. It's not what I'm discussing. It's just, as we discussed before, Mark, ramping up straddle implied volatilities in front of earnings or what have you, because here it doesn't matter whether the movement is up or whether the movement is down. It's not a perception of that kind of inverse relationship. It's just a perception that something may happen to drive prices sharply in one direction or another, so I'm going to charge you more for that call or that put in whatever direction we might go. That's a different
That's a good question.
concept.
That's another nail, I think, in the coffin of the volatility feedback effect. Is we don't see it as often. We always correlate increased volatility with a downside move, but anyone who's been on the floor for any period of time knows there is a phenomenon known as the upside crash. And when your underlying continues to move to the upside, and volatility will increase because of a variety of factors, including paper flow to the upside and a variety of other things that are going on up there. And I've experienced it a number of times, and I'm sure many others have as well. So volatility volatility increasing doesn't necessarily mean a downside move is imminent. You could indeed have an upside crash as well. So that I think is another nail in the coffin of the volatility feedback effect theory, that you can only move to the downside with an increase in volatility. That a volatility increase by definition has to crush the market. So that I don't think that's necessarily the case.
Yeah, I would tend to agree. And of course, I did mention realized volatility before because people may actually wonder, Bob said, I can't see any justification. So I can see the justification my way. You're worried about something and the perceived risk. So, have to have risk reward. Prices have to get cheaper and vice versa. But, I don't have a feeling for why it should be the other way around. Well, I kind of do have a feeling why it should be the other way around. And again, you and I have discussed it on many fronts. Surely, as you move along the implied volatility skew, and we know that exists, and prices drop, you move to a new level, you move to a new regime, you move to where implied volatilities for the at-the-money options are higher than where they are right now. And so as the market is dropping, you're looking at the entire calculation for VIX, which is most heavily weighted for the at-the-money options, and you realize that you're at a point now where you weren't, an hour ago, and those implied volatilities for what we're now calling the at-the-money options are simply higher than they were. So, surely there's a cause and effect there. And finally, you have to realize that although it's a biased forecast, and although I'm not a big fan of putting a lot of stock in implied volatility as a predictor of future realized volatility, it's still the widespread belief and concept that there is at least some relationship between current implied volatilities and what future realized volatility will be. And it's also a fact, and I didn't discuss it before, it's also a fact that when you separate out market movements to the downside and compare them with movements to the upside, and then calculate a realized volatility based on those movements, it's an observable phenomenon that downside market volatility is somewhat higher than upside market volatility. We've mentioned it before. Actual volatility, realized historical volatility, tends to be greater when the market drops because it tends to do so in a more precipitous fashion with calamitous drops, and the market tends to climb a wall of worry and go up in a more orderly fashion, so that when we separate out down movement in the market from up movement in the market, we find that down moves are by several percentage points create higher realized volatility than up moves do. So that being the case, why wouldn't we expect that a down move in the market would produce a concurrent increase in implied volatility, which is trying to forecast, future realized volatility anyway? So the whole thing seems terribly logical to me, perhaps less logical to Bob, and he expressed his points of view, but I just wanted to perhaps give a little bit of a rebuttal and give my thoughts on the matter in today's show. Give our
listeners some insight into the raging debate at the heart of the volatility exchange that is tearing apart friend against friend and brother against brother over in the walls there of the volatility exchange. But I think
it's like the Montagues and the Capulets.
Yes, it is. And Bob made a good point. I think when we do our great skew spectacular, Don, and we bring back, let's say, Robert Engel, we can give him a chance to weigh in on this as well and see what he thinks on topics like these, and maybe some of our other guests like you and Sinclair as well, when we do our Skew Palooza, as you say, which will be an upcoming episode whenever we get that planned out. Nothing on the calendar right now, listeners, but we are toying with that idea. But that is going to do it for this Volatility Viewpoint segment. And now we're going to roll right into our Crystal Ball segment.
And now we take a look at the Crystal Ball.
And welcome to the Crystal Ball section. This is, of course, the portion of the show where we prognosticate wildly and indeed irresponsibly about all sorts of volatility. And of course, I am joking, but we do tend to prognosticate a wee bit here. And we'll kick things off with looking at the broad market vol in the S&P and indeed the VIX with our good old volatility pit reporter, none other than Mark Byam Sebastian. Mark, how are things going in the land of premium buying, aka optionpit.com?
Oh, things are, yeah. Well, we like to say, we take what the market gives us. We're not buyers, we're not sellers. And Mark, the one thing that I'm really noticing today is the performance of VXO relative to VIX. For those of you that are unaware, before VIX existed, it was just calculated via the OEX, and it was a much more straddle and at-the-money weighted index at the time. The current VIX that everybody quotes has a lot of skew. It's got like this ridiculous kind of Vega weighting to it. It's not really Vega weighting, but it is Vega weighting. But the VXO, I like to look at it still because it gives me a much stronger feeling for what's going on kind of at the money. And if you look, the VIX is up, 5 handles today. VXO's up almost 8. So it shows you that where kind of the concentration of premium buying is. It's not a lot of people going and buying those tiny tail puts. There's people out there buying up premium and straddles. And so it tells me that there is expectations of a lot of market movement going forward. I can't argue with them. It's really difficult for me to sit here and say that the market's not going to keep doing what it's been doing. I mean, this has been like, and we're going to threaten. I think we're going to threaten that 1100 level, and this time we actually do get there. But we cannot get out of this until we probably threaten down there again.
I suppose that doesn't come as a great surprise, the lack of downside put buying. The people have been notoriously reticent to buy those puts even of late. We saw them selling almost into the teeth of the madness a few weeks ago, and that kind of tapered off when the true madness hit. But right now, as we see, even then they're still not loading up on the downside out there. I think there's either you're right, they want more bang for their buck and they're going for some of the meatier options, or they're just
well, I mean, with where skew is, if you're bearish, it is much cheaper to put a put spread on than puts. You do a put spread, at least you're selling some crazy high vol against your crazy high vol you're buying. I mean, this premium is expensive, but for how expensive premium is, skew's even more expensive. So that's kind of what I'm looking at.
Yeah, always take the nuanced approach and do the spread whenever possible. Don't just run out and naked gobble up this crazy skew we're seeing right now.
Exactly. Speaking of that, I think I'm going to buy a put spread in SPY.
You go ahead. Are you still, speaking of puts, have you adjusted your VXX position at all, or?
Yeah, I've rolled all that into long term.
So I know, in case our listeners were concerned that you were coming down to the wire there.
No. Filled. All right. I just bought the SPY 114-109 put spread for $1.50. So, I like the risk reward on that. So, what do you think, Don?
Has a good shot.
Thank you. So, but yeah, that skew. So I think it's probably that VXO VIX spread is probably a result of at the money, like basically put spread buying, and that's probably what's driving that. Although it'd be interesting to see whether there's an OEX SPX 1.5 swap out there.
Size in the 1.5. I don't think you see that much anymore.
No, they don't. No, I mean more an option play. Whether you straddle swap would be what I'd be looking to do. But no, the OEX is done for, especially with the dawn of the
the SPX PM kind of puts the final touch.
Going to kill the OEX. Going to kill. It's actually going to do a number on SPY even.
I think that's the plan, right?
Yeah, that's the plan.
But of course, we do discuss the broad spectrum of volatility here on this show, including what's been going on in Euroland these days. And as we alluded to at the top of the show, it is an active day in Euroland with the one of the presidents of the ECB stepping down and all sorts of flux going on in the continent out there. So Don, given everything that we've been seeing, what's your outlook for the land of Euroval going forward?
Well, of course, as we mentioned earlier, today is an expiration, so the September 1 vol and 3 vol, 2 contracts are going out today. We talked about their prices a little bit earlier. So we now have the 1 vol for October, and at the same time, a new listing for the December 3 vol, not new in the sense that it's been trading, but now it will become the front month in the 3-month product. And interesting, I always like to look at the start at the predictions of Robert Engel over at the Volatility Institute, and he's got about 11.5 to about 11.65 or 6 for each one of the contracts, which is somewhat higher than what the 1 month went out for September, but very close to the same value for the September expiration. So anywhere from about 11.40 actually to about 11.46 is his current prediction, and we'll have to see where the opening trades are for the October and the December contracts, and then take a look at the relationship and see which way we might want to be leaning.
All right, sir, and thank you for that. That is going to do it for this episode of the Volatility Views show. I want to thank both of my cohorts for coming on the show, both Mark Sebastian from OptionPit.com, as well as good old Don Schlesinger from the Volatility Exchange. And Don, before we go, is there anything interesting, anything exciting, anything new coming up over at Volex.us that you want our listeners to know about?
I don't think there's anything new on the website as of this past week, but again, not to whet people's appetites too prematurely, we are in very active discussions to try to bring vol contracts and perhaps even other volatility products and instruments out on some major indices, and as talks are going forward, they're looking very promising. So yet again, I hope to have more concrete news in the weeks ahead.
I know a lot of our listeners are chomping at the bit for those products to launch. So as soon as you know anything, Don, we want to hear it here first. That's going to be
absolutely
your source for all Volex information, of course, Volatility Views. And if you'd like to interact with us on the show, as some of our listeners did today, then you can surf on over to theoptionsinsider.com and then click on the forum section where you can scroll down to the Volatility Views listener questions forum and post your questions or comments there. You can also reach us via Twitter, twitter.com/options or twitter.com/Volex_info. You can also find us on Facebook. Just search for Options Insider or Volatility Exchange. There is no shortage of ways to reach us these days. The hardy among you can even dial us up at 312-544-9356 and leave us a voicemail. But that is going to do it for this episode, and I want to thank all of our listeners out there for downloading and streaming and subscribing to this show, particularly those of you who have found your way to the new feed that just launched in iTunes last week. It's already found a strong base of subscribers, and we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volex_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.